When headlines flash with news of institutional collapses and bank panics, a very specific, very modern kind of anxiety sets in. We tend to think of a bank as a hyper-secure storage unit. You deposit your paycheck, and you assume that exact cash is locked away, sitting quietly behind thick steel doors, waiting for you to ask for it back. But here is the reality. The moment you hand your money to the teller, it immediately leaves the building. The truth is, banks rarely hold enough physical cash to cover all of their customers' deposits at any given moment, which brings up an obvious contradiction. How does a system that operates by systematically getting rid of its customers' money serve as the stable foundation of the entire global economy? To understand why modern financial crises happen and why the economy hums along when they don't, we have to trace the invisible journey of a single deposit from the second it leaves your hands. For a long time, the answer to economic stability was physical metal. Under the historical gold standard, a country's currency was strictly limited by the actual amount of gold it held in reserve. That system provided certainty, but it had a fatal flaw. During severe economic downturns, governments were paralyzed. They couldn't generate new money to increase liquidity and stimulate the economy without literally digging more gold out of the ground, an inflexibility that severely worsened the Great Depression of the 1930s. To fix that paralysis, modern economies switched to something entirely different, fractional reserve banking, and it operates on the exact opposite logic. Here is the mechanical trick of the modern system. When you make a deposit, regulatory authorities require the bank to keep only a tiny percentage of it in the vault. That is the fraction in fractional reserve. The rest of it, the bank immediately loans it out. Your deposited paycheck gets sliced up and dispersed to fund someone else's mortgage, a neighbor's auto loan, or the working capital for a new factory. A bank is a business, and they profit on the spread. They might pay you a 1% yield for keeping your money in a savings account, while simultaneously charging the borrower 6% on that mortgage. By repeating this process, lending out the vast majority of every deposit they take in, banks effectively create credit out of thin air. It's this constant multiplication of money that fuels constant global economic growth and job creation. But that immense power comes with a built-in vulnerability. The entire structure requires absolute, unbroken trust that not every customer is going to want their cash back on the exact same day. The moment that trust evaporates, you get a bank run. If mass panic sets in and thousands of people demand withdrawals simultaneously, the bank simply won't have enough cash on hand to pay everyone, instantly draining those fractional reserves. Even without a panic, there is a secondary macroeconomic risk. When banks create massive amounts of loans, they expand the overall money supply. If that money supply grows faster than the actual economic output, it erodes the purchasing power of your cash, driving up inflation. Because a bank's primary incentive is to maximize profits for its shareholders, the system naturally encourages constant lending. If left unchecked, this pursuit of yield pushes institutions toward excessive risk-taking, inflating the dangerous asset bubbles that often precede global financial crises. To manage all this capital and mitigate these risks, the financial system is divided into specialized tiers. At the foundational layer, you have retail banks. These are the consumer-facing institutions where everyday citizens store cash, secure personal loans, and get credit cards. Step up a rung and you find commercial banks. These cater directly to businesses, providing massive lines of working capital, treasury management, and the complex trade finance required to keep large corporations operating. Scale up again, and you reach the investment banks. These Wall Street giants don't deal with checking accounts. They operate strictly in capital markets, acting as intermediaries for corporate mergers, acquisitions, and the underwriting of massive securities offerings. As money flows upward through these interconnected layers, a single local deposit transforms into the high-stakes instruments that drive international trade. At the very top of this pyramid sits the ultimate authority, central banks. These are independent government institutions, like the U.S. Federal Reserve, and they never deal directly with the public. Central banks oversee the entire commercial banking sector. Their mandate is to manipulate interest rates to control inflation and, crucially, to act as the lender of last resort, injecting emergency liquidity into the system to prevent a total collapse when a bank run drains those fractional reserves. While this modern digital architecture seems incredibly complex, the base logic of pooling resources to fuel economic growth dates back thousands of years. Ancient Mesopotamian merchants and Babylonian temples were issuing grain loans to farmers using a remarkably similar foundation. A bank is rarely the passive vault we imagine. It is an active, multiplying engine of credit built entirely on fragile human trust. Grasping how that engine runs is the only way to truly understand the mechanics of the modern world.